Good day, everyone. Welcome to our quarterly webinar. Excuse me. It's John Longo, our Chief Investment Officer. As you know, if this is your first time, welcome. On a quarterly basis, we pretty much recap what has happened in the markets and also share our outlook. So here's our roadmap for the next 30 minutes or so. As usual, we'll kind of recap what happened last quarter. As always, there are some winners and losers. We'll talk about what's going on in the macroeconomy. We'll give our outlook for the stock and bond market. We'll talk about any changes over the quarter to our model portfolios. And as usual, we'll kind of end with our target portfolios that are a guide that we ultimately tailor to your unique situation. So let's get started. Q1 was pretty volatile. It was really a tale of two or really three cities. So if you're looking at the screen, we kind of came out pretty strongly out of the gate in January. The market was up around 7% at the end of January, but then February hit. And we had not one, but two corrections over the quarter. The first one was due to a surge in interest rates, or at least a relative surge. And you can see here the drop from +7 to roughly down 4. So that counts as a correction. Those that aren't familiar with market terminology, a correction is a pullback of at least 10%, but not 20%. 20% or more would get us into the bear market territory. So we had a correction in this February timeframe. Market kind of rebounded and then had another correction here in March. That one was set off by the threat of a trade war between the US and China and really maybe the rest of the world. Fortunately, since the end of March, and I'm recording this approximately the third week of April, the market has recovered the bulk of its losses. It's down less than 1% as I'm delivering this webinar. So a lot of volatility, which we didn't experience in last year, and I'll kind of elaborate that as the slide deck unfolds. So that's the stock market, two corrections in one quarter, just to give you some numbers. Historically, we have one correction every year to year and a half. So to have two corrections in the span of really 2 months, that was quite atypical. But we started off from an abnormally low volatility base. Moving on to the bond market, well, a big story that's unfolding is the rise in interest rates. Now, as you probably know, interest rates aren't just one number. There are short-term rates, which the Fed directly controls, and then intermediate and long-term rates, which are more market-driven. So the benchmark yield in the US is the 10-year Treasury. It's tied to a lot of things. It's tied to corporate borrowings. It might be tied to your mortgage. The average person, even if they have a 30-year mortgage, may live in their home around 7 or 8 years on average. So it's an important benchmark, and that number has moved up from 2.4% on January 1st to 2.75% at the end of the quarter. And as I'm delivering this webinar, it briefly touched 3%, the first time in 3 or 4 years. It's dipped down a little bit below that to around 2.9, 2.95%. So clearly rising rates, generally not good for most conventional fixed income securities, but I'll elaborate on some of the things we have to mitigate that risk, namely some floating rate debt and munis with a low duration. In terms of recapping the performance for various indices, let's kind of run that down. In terms of US equities, the S&P is the major benchmark. That fell a little bit less than 1%. Nothing to write home about, but clearly disappointing if you're looking at your statement at the end of January. Within the market, there are different segments: growth, value, large cap, small cap. Growth had a good quarter. Once again, like most equities, they pulled back a little bit as the quarter came to a close. But growth, especially technology, had a solid quarter. Conversely, value not so good. Value down 2.83% in contrast with 1.4% increase in growth. International was a mixed bag, although slightly better than the US. Emerging markets were up 1.5% or so, and some other developed international indexes were down 2%. The most common bond index is called the Barclays Aggregate, That fell 1.5%, worse than stocks. So in this case, fixed income diversification did not pay. But as I mentioned a moment ago, short-term munis did okay, edged up a bit in positive territory. Commodities also a mixed bag. So for example, oil was up, but other commodities were down. But let's call it roughly flat. Last but not least, at least on this slide, real estate. Well, REITs are interest rate sensitive. So when rates go up, pure REITs, market-based REITs, those that trade on the exchange, tend to go down, and they were hit fairly hardly with an 8.5%, 1.5% drop. So a mixed bag, generally slight gains to slight losses. That's how I'd summarize it. In terms of our specific holdings that are in most client accounts, but not all client accounts, well, Harding Loevner, a long-term global fund, has continued its stellar performance, up 2.25% roughly in Q1. An addition to our portfolios last year, the PowerShares Floating Rate Senior Loan Fund, that actually went up 1.3%. So just briefly to describe these are floating rate funds tied to LIBOR or some other short-term interest rate. And as rates go up, they actually tend to do better. So this is one way we try to diversify fixed income risk. Some of you have been investors in our real estate fund, Versus. This is a largely private fund, about 75% is private, 25% public. And that edged into positive territory, which we'll take, especially given the sharp decline we saw in the previous slide with publicly traded REITs. Small cap did better than their large cap brethren, edged into positive territory about 0.57%. Another solid performance in the fixed income arena came from the BlackRock Strategic Income Opportunity Fund that increased 0.43%. You might be wondering, how can some of these bond funds deliver positive returns when the benchmark is down? Well, we kind of covered that with the floating rate bond fund, but the BlackRock fund can involve some long-short positions. So long is what you think is going up, short is what you think is going down. And if they've made the correct call, you can actually deliver a positive return. So we're very pleased with BlackRock last quarter. A new fund that I'll talk about, the Versus Capital Real Asset Fund, has a lot of things in it. Infrastructure is one of them. It's the newest addition to our platform, and that also edged into positive territory, plus 0.36%. So I'll give you some more detail on that a little bit later in the slide deck. One of our in-house strategies, the Beacon Trust Core strategy, an equity strategy mostly tilted towards growth, also moved into positive territory ahead of its S&P benchmark. So that's the good news, at least relatively speaking. Now let's move on to the bad news. Fortunately, it wasn't really a disaster, but we had some investments that declined in value, unfortunately. Some of our in-house strategies that are value-oriented, we just mentioned that value had a rough quarter. Well, our dividend strategy and income and appreciation strategy, both of those have dividends generally at least 50% higher than the S&P, sometimes double that. They got hit hard. So most income proxies, utilities, REITs, other things as well, didn't fare so well. Oakmark, a fund that had great performance last year, a little bit slow this year, down 2.77%. Another dividend or income-oriented fund, Vanguard Equity Income Fund, down 2.5%. And the Beacon Accelerated Return Fund, down 1.83%. So that's the relative bad news, but it's relatively tolerable when you have losses in the low single digits. Now let's move on and talk about what's going on in the macro economy. So these are some of the indicators or tea leaves, so to speak, that I like to look at. So one that we're seeing on this screen is LEI. LEI stands for Leading Economic Indicators. And it's a basket of 10 or so underlying indicators that can include industrial production. It could include hourly wages. It actually includes S&P stock prices. But it has a pretty good record of declining in advance of recession. So if you're looking at the screen, the gray area reflects recessions. And what you'll notice is pretty much before every recession, we see a downdraft in this LEI indicator. And looking at the right-hand part of the screen, you can see we've been up largely since the end of the recession in 2009. And especially if you look at the inset here on the right-hand portion at the bottom, we're in good shape. It's moving straight up. So the takeaway is that from this important indicator, no near-term signs of recession. And this data comes out every month, and I typically, will include it in my quarterly slide deck. A couple of other leading indicators. ISM stands for Institute for Supply Chain Management. And you could view those analysts or investors as purchasing managers. Excuse me, they do a survey of these purchasing managers and they say, what do you see for the month ahead? And if the number is greater than 50, it signifies expansion. If the number is less than 50, it signifies potential contraction. Now, I wouldn't put too much stock into any one month, but as long as the past several items have been above 50, it probably tells you we're still expanding. And what you can see here, if you're looking at the screen, this is manufacturing. The number is pretty healthy. Yes, it's down from last month of 65, but anything above 50 is good, and above mid-50s is pretty solid. This is driven by a lot of things. Manufacturing, of course, is defense. That also includes energy, includes auto manufacturing if you're looking at GM and Tesla. So a pretty good report card for manufacturing. The same group, ISM, also produces a non-manufacturing index, informally known as services, and that would include a lot of things. Financial services, a big component, healthcare, others. Same interpretation. If the number is higher than 50, it signifies expansion. The outlook is relatively good. And we have a similar story to the prior slide. We see a dip from the prior month, but still healthy levels. So according to these three important indicators, economy is still in good shape. Moving on to another one. Another thing that can push the economy into recession is when banks stop lending, a so-called credit crunch. So fortunately, the Fed tracks data of bank lending, and what you can see here is that on a year-over-year basis, excuse me, we're up around 3 or 4%, which is in line with GDP. So no sign of a credit crunch, and that is also relatively positive for the market outlook. Now, one thing that can cause inflation, really two things, one is on the screen, one will be on the next screen, is wage inflation. Wage inflation, of course, is basically an increase in paychecks. And what you can see here is there's been an uptick, certainly over the past prior years. Right now, the reading's around 2.6, 2.7%. But only when you get to the 3.5% or so range, then you really have to worry about inflation taking off. So I would characterize wage inflation as on an uptrend, slightly concerning, but not terribly worrisome. We'll keep an eye on it. This just says inflation is rising, but not out of control. The second main indicator for inflation are commodity prices. Commodity are a lot of things: oil, gas, wheat, corn, rice. So on this basket, you can see the gradual uptrend since 2016, but clearly way below where we were in 2014-15, when you might recall oil over $100 a barrel, as opposed to the $70 to $80 that it's in that range today. Okay, so to summarize, the economy's in very good shape, or at least relatively good shape. If I had to give it a grade, it'd be a B+, maybe A-. We see unemployment at the lowest level since 2000. If you're wondering what a lower bound might be, I would say probably around 3.5% based on some prior recessions. GDP has been solid. Most of the quarterly data coming out are showing a number between 2.5% and 3.25%. So we'll take that. And I'd remind you that the tax relief and stimulus is now just starting to take place. So I would continue to expect some follow through in terms of spending and decent GDP. We're in the early part of earnings seasons, and the outlook has been relatively good, and the reported earnings have been very strong. Consumer confidence has been strong, up near record level. The consumer is about 2/3 of the US economy. Real estate prices actually surpassed at the national level what they hit prior to the Great Recession. Of course, real estate is a regional market, so the coastal areas may be under pressure with the new tax changes, but middle America should be in good shape for real estate. And as I mentioned a moment ago, some of the common leading indicators are pointing to continued growth. In terms of stocks, even though we're treading near the break-even point as I deliver this webinar, we think we can get to mid to high single digits by year end. And that is driven by the tax cuts, lower valuations, where the pullback in the market has made things more attractive, increasing consumer spending, and a slight decrease in some of the international risks. So we think the S&P, when I'm doing this presentation in December, is going to show a decent gain, not last year's 20% plus gain, but a high single digits. We're hoping to get there. We're not crazy bullish because of somewhat elevated equity valuations, not as much as when we came into the year, but more importantly, rising interest rates, the Fed gradually reducing its accommodations. In terms of where we might see better value, well, small cap, we think probably has more room to run. They benefit disproportionately from the tax cut. They also lagged last year. International, valuations are better, and the central banks are still actually accommodative as opposed to the US, where they're gradually exiting. You might say, what would change our views and put us in a more cautious scenario? Well, if some of these indicators suggested a forthcoming recession, we would get more cautious. What that would look like is perhaps reduce your equity allocation, perhaps raise more cash, but we are always going to have a diversified portfolios in nearly all client portfolios. We're never going to say sell everything and go to cash. That generally does not make much sense. Looking at valuations, one way to measure valuations are PE, price to earnings ratio. Just to give you a simple example, if a company is valued at $1 billion and it has earnings of $100 million a year, that PE would be 10. So currently, we're almost exactly or slightly above the 25-year average. So as of March 31st, the PE was 16.4. Well, the 25-year average is 16.1. And if you look at these other valuation metrics on the top, it shows generally slight overvaluation, but there are others that point to undervaluation. So I would just characterize the market as not cheap, but not terribly expensive. And clearly the pullback that we had with the two corrections in Q1 have made valuations more reasonable. And that takes me to my next slide. I can give an overall number like the PE is 16.5, but you need to look under the hood. So we have some growth-oriented companies, Facebook, Google, Salesforce, Amazon, with high PEs. So if you're seeing this graph for the first time, red means the valuation is high, usually because of high growth, and green means that there's some value, generally below average market valuations. So looking at the screen, we see some good pockets of valuation in financials. We see some pockets of valuation in healthcare. And if you're so enterprising, if you don't believe the electric car is going to be here anytime soon, or the driverless car en masse, Ford and GM are trading at low single-digit PEs, among the cheapest stocks in the market. Now let me elaborate a little bit on historical market drawdowns. Unless the market ends up at a 52-week high in December 31st, there has to be a drawdown intra-year. So I realize there's a lot going on in this graph, but there's a few takeaways that you can get, at least two. One is that usually around 75% of the time, the market does wind up in positive territory. That being said, even during those positive years, you're going to see a drawdown. So last year, as I mentioned, the biggest top to bottom drop was only 3%, abnormally low, incredibly so, and that was the lowest since 1995. So this led us to believe that volatility was going to pick up this year. We did forecast a correction, or probably slightly surprised with 2 corrections in the span of 2 months, but we knew volatility was going to pick up. So volatility alone is not enough to scare us out of our current position. Okay, so the method is, or the takeaway is, consider staying the course because volatility is a normal part of investing in equities. Now, we had a couple of pretty large drawdowns. If you listen to the TV show or popular press, you saw the greatest drop in the Dow ever on a point basis. Well, point basis isn't terribly meaningful. You need to look at a percentage drop. Back in 1987, the infamous crash of 87, the market fell 22% in one day. Now, that's a huge drop. We did have 1 or 2 4% drops, which is certainly unsettling, but it's not 22%. And you might be wondering, what happens after a 4% drop? Well, the answer, as shown in this picture, is a study by Bloomberg, is the market usually bounces back. Usually after 5 days, it recovers a part of the drop. After 30 days, it recovers most of the drop. And 1 year later, you have typically the normal return for the stock market, about 10%. So if you're looking at this, it says 14%. So 4% would be the drop, and the 10% would be the normal historical return. Bottom line, the market usually rebounds after a large drop, especially after about a month or so. Now, if you want to make a bullish case on why stocks can go higher, there has been a underinvestment in, let's call it, long-term property, plant, and equipment. Accountants call this CapEx, or capital expenditures. Since the end of the George W. Bush years, there's been a reluctance of companies to invest. Now, it's too soon to tell, but the new tax plan does give companies an incentive, a tax incentive, to invest for the long term. And if you're bullish, maybe some of this gap can be closed, and therefore the current expansion, and by extension stock market rally, can be extended perhaps at least a couple of years. We'll keep an eye on it, but it is one bullish case. Now, in case you're wondering what typically causes a bear market, and about 10 minutes ago I defined a bear market as a 20% or more drop from a peak, it's usually one of these things with the diamonds over here if you're looking at the screen. A recession is the #1 cause of a bear market, and as I've shown with the indicators, we don't really see a near-term recession on the cards. 2019 might be another story, but I'm doing Q1 2018 webinar here. We've seen an uptick in commodity prices, but not a huge spike like we saw in 1973 or 4 or some other periods. The Fed I would characterize as generally accommodative, gradually tightening policy, but I wouldn't call them aggressive. Those that have watched the Fed in the past might recall times where they've raised rates 0.5% or even 0.75% after one meeting, as opposed to the 25 basis points movements they've been doing recently. Last but not least in this area, extreme valuations. I wouldn't call the current valuations extreme. I would call them slightly expensive. But the takeaway is that we are currently in the midst of the second longest bull market on record, and I'm likely to believe that this will actually be the longest bull market on record. We just need another 4 or 5 months. And this is also the second largest rise since the bottom of a bear market. The biggest rise was during the internet bubble, where we increased from top to bottom 417%. Here we're up a little less than 300%. So I doubt we're going to get to the 417%, but I think we are going to make this the longest bull market on record. A big unknown is the Fed unwinding its balance sheet. It could manifest itself in even higher interest rates. If you're wondering what's going on the screen, this is the size of the Fed balance sheet. Before Lehman went under, it was around $750 billion. The Fed, in an effort to prevent the economy from collapsing, engaged in a number of rounds of what's called quantitative easing. Basically, it's printing money in order to buy long-term treasury and mortgage-backed securities in order to keep interest rates low and spur economic activity. So there are several rounds of QE, at least 3 rounds, and the Fed's balance sheet stood at $4.5 trillion up until a few months ago, and it's gradually shrinking it by about $10 billion a month, which is quite slow on a $4.5 trillion base. But an unwinding of this magnitude has never occurred before, so it is a risk, and as I said, the main risk is it could result in rising interest rates. Speaking of interest rates, the yield curve, in case you're not familiar with that term, shows the relationship between time to maturity and yield to maturity. I know there's a lot going on the screen, but what we have here is the current curve in red and last year's curve, pretty much 1 year ago today, in white. So what's happened is the Fed has raised rates at the short-term end of the curve, while long-term rates have been relatively constant. This has created a flat yield curve, and if you get the opposite, where short-term rates are higher than long-term rates, that's called an inverted curve, and that's usually a forecaster of a recession. So we're going to keep a close eye on that. But the takeaway is that the yield curve has become flat, short-term interest rates have become more attractive, and long-term interest rates have become riskier, at least if you're investing in long-term bonds. So our bond market outlook is the following. We expect the Fed to raise interest rates 3 times in 2016, including the ones that it raised in Q1. There is a reasonable chance it could go raising rates 4 times if we continue to see relatively modest inflation and 3% plus on GDP. The Fed may raise rates 4 times. But we would expect interest rates to increase in an improving domestic and global economy where we are, and when the Fed is raising rates and shrinking its balance sheet. So what has occurred so far in the bond market is not surprising to us at all. We think the benchmark 10-year is near the upper end of its range. Coming into this year, we said it'd be between 2.25% and 3.25%. As I mentioned at the top of my talk, right now it's around 2.9, 2.95%. So if you're holding bonds, we expect the best you can do is clip your coupon. Probably won't get there if you're looking at a calendar year basis, January to December. But you'll collect your coupons, and as interest rates gradually go up, you'll be able to invest them at higher rates. So we're hoping the broad fixed income benchmarks like the Lehman Ag might get into very low single-digit territory. By that I mean 1%, or if we're lucky, 2% by the end of the year. Let's move on to the risks. Well, a major risk is just a shift in market sentiment. With interest rates at the 10-year level approaching 3%, some investors may say, well, I'll take that return and I'll take the money out of the stock market and put it in the bond market. That would basically reduce the PE multiple on the market. I mentioned a few slides ago, 16.5. The historical number, going back to when we have data in the early 1940s, is around 15. So people can just say, I'm going to allocate more towards bonds, take money out of the stock market, and that is a risk. Now, a second major risk, which is the third bullet on this slide, is a potential trade war with China. China, as you know, is the second largest economy in the world. Not only that, it's a big market for many of the leading companies in the US. Apple is one, Starbucks another, GM is another. So if this snowballs into a very serious trade war, which it currently is not, it could be bad for equities as a whole. Currently, there have been some minor tariffs on things like solar, washing machines, steel, aluminum, but it's not a full-blown trade war, and things seem to be moving in the right direction. Speaking of moving in the right direction, the US is scheduled to have a summit with North Korea at the end of May or early June. And to get nuclear weapons off the Korean Peninsula, I think we'd all agree that would be a big positive. Excuse me. So by the end of Q2, we'll have some insight into what's happening, but the early results are good. But it's, as Yogi Berra said, it's not over till it's over. Other risks, well, with the tax cut, that may increase the budget deficit. By most estimates, that deficit's going to be in excess of $800 billion in fiscal year 2019, which will start in July. And generally, large deficits tend to result in rising interest rates. There's a term that economists use called the crowding out effect, that if the government's borrowing a lot of money and corporations are borrowing money and individuals borrowing money, well, rates have to go up in order to have everybody fund that debt. Another risk we're worried about is retail bankruptcies. Pretty much everyone of every age remembers Toys R Us. Toys R Us has declared bankruptcy, and it's ongoing whether they're going to completely liquidate their stores. I know there was an offer to purchase some of their stores, and that would be sad for anyone that's ever been there as a child or taken their child or grandchild there. And you can see here, if you're looking at the graph, is that if you go back to last summer, Toys R Us bonds are trading at 98 cents on the dollar, and then 2 weeks later, when the news of their financial turmoil came to light, they were trading between 20 and 30 cents on the dollar. So the vast majority of retailers are in deep trouble. Your traditional retailers like a Sears, a Macy's, JCPenney. There are some that can survive, if not thrive. TJ Maxx is one that comes to mind. You need a compelling value proposition these days with Amazon and now a new and improved Walmart, so to speak, taking up the lead in e-commerce and combining bricks and mortar. Amazon, as you know, has purchased Whole Foods as their plan to sell more groceries. In terms of portfolio changes, there were no new changes. We've implemented some changes that we alluded to in our prior call. I'll summarize that and provide a little bit more detail. We added to the Versus Capital Real Assets Fund. And how we did that is, for most clients, we funded that with the FPA Crescent Fund. So why do we make that switch? Well, FPA was more of a balanced fund. They had a big allocation to bonds and cash, which we didn't think made a lot of sense. We have enough equity exposure in our other strategies. And we think the Versus Real Assets Fund adds some unique elements to our portfolio. Versus holds a mix of infrastructure, farmland, and timber, which I'll get to on the next slide or so. About 75% of the assets in this fund are in private vehicles, while the remaining 25% is through public vehicles, whether it's a stock or real estate investment trust in that area. We also added slightly to our international and small cap exposure. As I mentioned at the top of the talk, we think there are better valuations in those segments, and so far it's proven in aggregate to be correct. A little bit closer look on the Versus Fund. So you might say, what's infrastructure? Well, maybe on the way to work or travel or leisure, you've been over a toll road, a bridge, a tunnel. You've been to an airport, wireless towers, wind, solar. These are all considered infrastructure assets. I'm sure we've all been to a farm, and you know that there are many types of farms. They typically specialize in a certain crop: corn, soybeans, rice, wheat, potatoes, walnuts, cranberries. There are hundreds of types of crops that can be produced. And on timber, there's a whole range of things. There could be everything from paper that you use for your inkjet or for, let's say, paper towels, to building materials that might be used to build a home or a commercial structure. So this is under the hood of what's in Versus. We think it's a nice complement to the potential for rising rates and rising inflation. We think they'll give a better risk-return kind of trade-off versus pure bonds. Although we would put this in our hybrid or alternative category, we wouldn't put this in our bond category. Speaking of categories, we have our traditional three portfolios: conservative, moderate, aggressive. that ultimately we tailor to each client to try to best match their goals and objectives. And what you can see here on the conservative piece, it's a pretty strongly balanced portfolio. You'll notice that we have 27% in fixed income, which is a reasonably sized allocation. Short term would be money market type funds where we're trying to get you something higher than 25 basis points. Hybrid would be things that have the characteristic of stocks and bonds. Our planned return strategy would be one example where it has some downside protection. Our real estate investment trust might be there. An alternative, I think the new Versus fund would fall there. Years ago, you probably may recall we had some fund of hedge funds that would fall in there as well. The moderate portfolio, as you'll see, reduces the fixed income slice from 27 to 17, increases the equity slice, and virtually eliminates the short-term quasi-cash position. But this is still a balanced portfolio in the context of most pension funds or other retirement plans. Our last portfolio, the so-called aggressive, it tends to be equity focused. We have here 74% equity. You'll notice there is no cash and there is no traditional fixed income. We think the risk return in cash and fixed income is not compelling, and we can do better with some of the funds that I alluded to early in the presentation. So that's our start to the quarter, kind of a tale of two cities. Ended the quarter on kind of a flattish note, and we're hopeful that we'll get into positive territory as the year unfolds. So that's it for our call today. I hope you enjoyed it, and I look forward to meeting with you soon. Have a great day.